Your business can cash flow for a loan and you can still fail the lender's cash flow test. How? Because some lenders don't stop at your business's DSCR. They also calculate Global DSCR or Global Debt Service Coverage Ratio. Business DSCR essentially asks, does the business generate enough cash flow to cover its debt payments? Global DSCR takes a broader look at the business and its owners or guarantors to determine whether there's enough cash flow to support both business and personal obligations. And this is where business owners can get caught off guard. Let's say your business generates enough cash flow to support the proposed loan. The business DSCR works. But then the lender reviews your personal tax returns and sees that most or all of your personal income is coming from that same business. Maybe you're paid a salary, or maybe you take owner distributions or draws. There's absolutely nothing wrong with paying yourself from your business. But that means the same business cash flow may be supporting both the business debt and your personal living expenses.
Why does that matter?
First, it can mean the business has less financial cushion than the business DSCR alone might suggest. If a significant amount of the remaining cash is needed to support the owner's household, there's less room for a slow month, unexpected expense, or decline in revenue. Second, the lender has to think about the personal guarantee. When you personally guarantee a business loan, you're agreeing to be personally responsible for repaying the debt if the business is unable to repay it. But if most of your personal income comes from that same business, there's a problem. If the business starts struggling, its ability to repay the loan may decline at the same time your personal income declines. So although the business and guarantor may look like two sources of repayment, financially, both may depend on the same underlying source of cash flow. And that's also why outside income can sometimes make a difference. Income from another job, a spouse, or another source that's independent of the business may help show that your personal obligations can be supported without relying entirely on the business. This can be especially important with startups and business acquisitions. So if a lender tells you your business DSCR works but your global DSCR doesn't, those two things aren't contradictory. The lender is looking beyond whether the business can make the loan payment. They're also asking how much of the business's cash flow needs to support the owners. How much cushion does that leave in the business? And if the business struggles, does the guarantor have another source of income to help support the loan? That's the bigger picture Global DSCR is trying to capture. The information in this video is for educational purposes only and does not constitute financial, legal, tax, or lending advice. Lending requirements, approval criteria, cash flow calculations, and results vary by lender, loan type, and individual circumstances. Always consult with a qualified professional regarding your specific situation.